Investor sentiment plays a major role in price movements. When the market is soaring, optimism or FOMO can drive prices higher. But when prices start to fall, fear sets in. This can trigger a vicious cycle of selling that drives prices even lower. A number of external factors have contributed to the recent crypto crash. Here are 5 of them. 1. Uncertainty about the future of cryptocurrency. These cryptocurrencies are volatile, and their price reflects market sentiment. When the market is euphoric, people buy because they believe it will increase in value, and they are driven by FOMO, fear of missing out. But when the market starts to crash, it's often because people feel fearful of losing money, and this herd mentality can cause the price to plummet. The volatility of cryptocurrencies is further compounded by the fact that there are no central authorities to regulate them. As such, it's easy for bad actors to manipulate prices by dumping shares or pumping up the price through a Ponzi scheme. These schemes can lead to a cryptocurrency market crash when they're discovered. In addition, cryptocurrencies are constantly evolving and adding new features, which can create a lot of uncertainty. For example, blockchains are being used for more applications than just Bitcoin, and this expansion can cause confusion and lead to price fluctuations. It can also result in forks, which can cause investors to lose money and create conflicting versions of a coin. Another factor is that cryptocurrency markets are very illiquid, which makes them susceptible to panic selling. This can lead to a sudden price drop, which in turn causes investors to liquidate their positions, driving the price down even further. Finally, the emergence of quantum computing is creating new security risks and testing cryptography's defenses. The uncertainty about the future of cryptocurrencies is likely to continue to push prices down until there's more clarity about what will happen with regulation. The Trump administration is expected to be more favorable toward cryptocurrencies, and Gary Gensler, the current chairman of the SEC, will step down next year, giving a more pro-crypto direction to the regulatory body. Two, uncertainty about regulation. And as with any new industry, crypto is vulnerable to regulators. When regulators change their stance or act on crypto, it can cause investors to panic sell and push prices lower. Additionally, regulators often don't provide a clear explanation of their reasoning. Instead, they use vague and confusing language that could be interpreted differently by different people. The regulatory uncertainty has also contributed to the recent crypto crash. For example, many investors have been selling their digital assets because they're afraid of the US SEC taking action. Others are selling because of the broader economic turmoil, which has driven down stocks and other traditional investments. Another factor contributing to the crypto crash is a series of security breaches and hacks. These events have eroded consumer trust in the sector and may have led some consumers to stop investing their money. In addition, many of the leading cryptos are plagued with technical problems, such as scalability and the potential for a hard fork. These issues can be expensive to resolve and can undermine the value of the currency. Lastly, the current crypto slump has been fueled by investor fear and greed. Crypto market volatility is a complex blend of speculation, regulation, or the lack thereof, news, emotions, liquidity, technological risks, and more. Warren Buffett famously advised investors to be fearful when others are greedy, and this is certainly playing out in the crypto world. 3. Forks. Forks are a natural part of cryptocurrency innovation, but they can also have a negative impact on the market. For example, if a fork results in disagreement within the blockchain community, it can lead to a split of the network, which in turn can destabilize the price of both the original and the forked cryptocurrency. In addition, forks can result from technical issues that require the community to decide how to fix them. In such cases, a hard fork can occur, which can be more severe than a soft fork. Lastly, forks can be the result of security breaches or other controversial events, which can cause the price of cryptocurrencies to plummet. As a result of these factors, the crypto market is more volatile than traditional financial markets. This volatility can be exacerbated by news that could have a negative impact on cryptocurrencies, such as regulatory uncertainty or government crackdowns. For example, the collapse of Luna, a cryptocurrency that was backed by real estate, exposed problems in the industry that can affect prices. Moreover, the bankruptcy of Coinbase and other major crypto firms led to mass layoffs, which can further depress the market. Lastly, the volatility of the crypto market is often the result of speculative trading and market manipulation. For example, pump and dump schemes can artificially inflate the value of a cryptocurrency, leading to a sudden price crash when the perpetrators exit the market. The illiquidity of the crypto market makes it susceptible to such schemes, which can have devastating effects on investors. This is particularly true for large investors, known as whales, who can single-handedly push the market down by selling off their assets. 4. High transaction fees. As cryptocurrencies become increasingly popular, their blockchains can quickly become overloaded with transaction data. This can cause a slew of issues, including slower processing times and higher fees. This problem is especially pronounced during high-volume trading periods. While blockchain technology is inherently secure, it's not immune to hacking and other security issues. These incidents can erode investor confidence and prompt questions about crypto's long-term viability. The lack of a unified regulatory framework has also created uncertainty about the status of cryptocurrencies. Some countries have embraced them, while others have imposed strict bans or crackdowns. This volatility can lead investors to question the safety of their investments, triggering sell-offs and driving prices down. New cryptos enter the market all the time, bringing with them fresh ideas and possibilities for their potential use. However, this can lead to the market becoming oversaturated and create competition between projects. This can weaken the value of existing currencies and lead to forks, which can further destabilize the market. The crypto market is prone to extreme price swings, and even the most stable assets can quickly crash if investor sentiment turns negative. This is because the crypto markets are not isolated from broader global economic factors, and these can have an impact on investor sentiment and investment decisions. 5. Lack of liquidity. Cryptocurrency prices can be volatile, and they are usually driven by investor sentiment. When prices are high, people are excited and believe that cryptocurrencies have a long-term value, while low prices make them fearful and anxious. These emotions can lead to a herd mentality, where investors follow the crowd and sell when everyone else is selling, further driving down prices. The volatility of crypto prices is also caused by a lack of liquidity. This is because many people invest in cryptocurrencies with borrowed money, and when prices drop, they have to sell their assets to cover their losses. This can cause the price of a cryptocurrency to crash, even if the underlying technology is sound. In addition, the volatility of crypto prices is often related to macroeconomic factors. For example, geopolitical tensions and economic sanctions can create uncertainty and cause investors to be more cautious, which may make them less willing to invest their money in risky investments like cryptocurrencies. Furthermore, higher interest rates can also cause investors to pull out of speculative investments and free up their cash for other uses, which can further drive down prices. The lack of liquidity is especially dangerous for cryptocurrencies, because they don't have the same protections as traditional markets. For example, most crypto exchanges don't have circuit breakers that pause trading when prices dive too quickly. This means that a crypto market crash can occur much faster than other markets, and it can be harder to recover from. Fortunately, there are steps that you can take to reduce your exposure to risky crypto investments. For example, you can diversify your holdings by buying different coins and staying informed about what's happening in the crypto market.